Hello and a warm welcome to the Manifested e-learning platform. Today we continue with the subject auditing. We are in our today's lesson going to study the international standards on auditing on error and fraud. International standards on auditing on error and fraud. And candidates, international standards on auditing provide comprehensive guidance to auditors on their responsibilities. And we have those standards that guide the auditor when it comes to error and fraud. So we have specific standards that guide the auditors on errors and fraud. On errors and fraud in an audit of financial statements. So we have specific standards, and the primary international standards on auditing dealing with this is the standard 240, ISA 240, which is titled The Auditor's Responsibilities Relating to Fraud in an Audit of Financial Statements. That is ISA 240. This ISA 240 should be read together with ISA 200, which is titled Overall Objectives of the Independent Auditor and the Conduct of an Audit in Accordance with International Standards on Auditing. There is also the standard number 450. This is 450, ISA 450, which is titled Evaluation of Misstatements Identified During the Audit. So these are the primary international standards on auditing dealing with errors and fraud in an audit of financial statements. This lesson we are going to highlight some of the aspects of these key international standards on auditing. And one key aspect is differentiating error and fraud. That is ISA 240. The intent is very key because ISA 240 explicitly states that the distinguishing factor between error and fraud is whether the underlying action that results in the misstatement of the financial statements is intentional or unintentional. Because errors are not intentional misstatements. Errors are unintentional misstatements, including the omission of an amount or a disclosure in the financial statements. If there is a disclosure in the financial statements or omission or an error, errors are not intentional. Whereas fraud is an intentional act by one or more individuals among the management or employees or even third parties involving the use of deception to obtain an unjust or illegal advantage. So that's a very key aspect of Standard 240. It differentiates error and fraud. The second aspect is auditor's responsibility regarding fraud and error. Auditor's responsibility regarding fraud and error, that is ISA 240 and ISA 200. Auditor's responsibility regarding fraud and error. And one responsibility is in relation to reasonable assurance. The auditor's overall responsibility or objective as per ISA 200 is to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether due to fraud or error. That means that the auditor is not to provide absolute assurance. The auditor only provides reasonable assurance. The auditor provides reasonable assurance, not absolute assurance. Then we also have primary responsibility for prevention and detection of error and fraud. Now, ISA 240 clearly states that the primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. They are responsible for implementing and overseeing a sound internal control system that prevents and detects fraud. It is not the auditor's primary responsibility to detect fraud or error. No, that responsibility rests with those who are charged with management. They are paid to do so. Auditor's responsibility is just to give reasonable assurance. The auditor's overall objective, as per ISA 200, is to obtain reasonable assurance that the financial statements as a whole are free from material misstatements. So those charged with governance, like the management, the board of directors, their responsibility is to prevent and to detect fraud. And while the auditor is not responsible for preventing fraud, they are responsible for designing and performing audit procedures to obtain reasonable assurance that material misstatements, whether caused by fraud or error, are detected. So the auditor has responsibility to structure and design audit procedures that will be able to detect fraud or error in the financial statements of the entity. I want to get that clear, candidates. The primary responsibility for prevention and detection of fraud and error rests with those charged with management. But the auditor has a role of designing and performing audit procedures that will enable him or her to detect the occurrence or to detect fraud. They have the responsibility or role of ensuring that their audit procedures help to obtain reasonable assurance that the financial statements are free from material misstatements, whether caused by fraud or error. You understand? Yes. Candidates, we are discussing auditor's responsibility regarding fraud and error. And ISA 240 acknowledges that the risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. Get that understanding, candidates. The standard acknowledges that the risk of not detecting material misstatement resulting from fraud is higher. That risk is higher compared to that resulting from error. The risk, I repeat, according to ISA 240, of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. And this is because fraud often involves sophisticated and organized schemes designed to be concealed, including collusion, including forgery, It may also include intentional omissions. It may include management override of controls. So the risk is higher when it comes to detection of fraud as compared to error, because error is not intentional. It's very easy to detect error as compared to detecting fraud, because fraud naturally is intended to be concealed. Those who perpetuate fraud, they do it in a very sophisticated way. They do it through forgery, through collusion and all that. You understand? Yes. Now, let's move on to the third aspect of this standard, and this is professional skepticism. Professional skepticism. What does the standard say about professional skepticism? That is ISA 200 and ISA 240. Now, skepticism is required the audit. Professional skepticism means having a questioning mind. Having a questioning mind. Auditors are required to maintain an attitude of professional skepticism throughout the audit. That means having a questioning mind. That means being alert to conditions that may indicate possible misstatements due to error or fraud, and critically assessing audit evidence. Critically, throughout the audit process, the auditor is required to maintain an alert mind, a questioning mind, professional skepticism throughout the audit. You understand? And the candidate's professional skepticism is particularly important when considering the possibility of fraud, as it requires the auditor to be alert to the potential for management to override controls, and also to recognize that audit procedures effective for detecting errors may not be effective in detecting fraud. Let's move on to the fourth aspect of the International Standards on Auditing on Error and Fraud. Risk assessment procedure. Risk assessment procedures relating to fraud. Risk assessment procedures relating to fraud. Now, ISA 240 requires the engagement team to discuss the susceptibility of the entity's financial statements to material misstatements due to fraud, including how and where fraud might occur. The auditor also must make inquiries of management, including those charged with governance, and also the internal audit regarding the assessment of fraud risks, processes for identifying and responding to fraud, and any knowledge of actual, suspected, or alleged fraud. Then lastly, candidates, the auditor must perform analytical procedures during the planning phase to identify unusual or unexpected relationships that may indicate risks of material misstatements due to fraud. And it's important also to note that the auditor is required to consider whether information obtained indicates the presence of fraud risk factors or events or conditions that indicate an incentive or pressure to commit fraud, an opportunity to commit fraud, or an attitude to justify fraudulent activities. So there is that aspect of risk assessment procedures relating to fraud. Five, risks. Response to assessed risks. Response to assess risks. And these are risks of material misstatements due to fraud. Responses to assess risks of material misstatements due to fraud. The auditor must determine overall responses to address the assessed risks of material misstatements due to fraud at the financial statement level. And that includes assigning and also supervising personnel with the appropriate knowledge and expertise. That also includes evaluating the entity's selection and application of accounting policies. It may also include incorporating an element of unpredictability in the selection of nature, timing, and extent of audit procedures. You understand? Yes. Then there is another aspect in regard to ISA 240, which is the evaluation of audit evidence. Evaluation of audit evidence and misstatements. Evaluation of audit evidence and misstatements. ISA 450 requires the auditor to accumulate all identified misstatements, all right, throughout the audit. And the auditor must communicate all accumulated misstatements to the appropriate level of management on a timely basis and request them to correct those misstatements. And if management refuses to correct misstatements, the auditor must understand their reasons and evaluate whether the uncorrected misstatements individually or in aggregate are material to the financial statements. And this evaluation will influence the auditor's opinion. So the auditor has to evaluate audit evidence and misstatements. That is a key aspect of Standard 450. 7, we have communication and documentation. Communication and documentation. The auditor here must communicate identified fraud on a timely basis to the appropriate level of management. And if management is involved, it should be communicated to those charged with governance. So the auditor must communicate with those charged with governance about their assessment of fraud risks, the nature of identified fraud, and also implications. So we have communication and documentation, which is a key aspect. Communication and documentation. So do you understand, Candice? Communication and documentation. The auditor has to communicate with management. But sometimes the management may also be part of the fraud. If the management are part of the fraud, then the auditor is required to communicate with those charged with governance. Those charged with governance could be the board of directors. You understand? So if the management is implicated, the auditor must communicate with those charged with governance about the assessment of audit risks, the nature of identified fraud, and the implications for the audit. The uncorrected misstatements must also be communicated. And in some jurisdictions, the auditor may have a legal or regulatory duty to report identified or suspected fraud to external parties like the regulators. So the auditor therefore has to consider such obligations. Now, as for the documentation, the auditor must document the discussions among the engagement team regarding fraud, the identified and assessed risk of material misstatements due to fraud, and also the responses to those risks, and also any communications about fraud to management or those charged with governance. Communication and documentation. So these are 7 key areas or aspects of international standards on auditing on error and fraud, specifically ISA 240, ISA 200, and ISA 450. So, candidates, you've seen that international standards on auditing provide a robust framework for auditors to address the risks of both error and fraud. And while recognizing that the primary responsibility of management and also charged with governance, the ISA place also significant responsibilities on the auditor to exercise professional skepticism. The auditor is required to do what? To exercise professional skepticism throughout the audit. The standard requires the auditor also to perform thorough risk assessments. The auditor is required to design appropriate responses and also communicate findings effectively to ensure reasonable assurance about the financial statement. The auditor is required to provide reasonable assurance. The primary responsibility for prevention and detection of fraud rests with management and those charged with governance. But the auditor has a responsibility to provide reasonable assurance that financial statements are free from material misstatements resulting from error or fraud. And that's it for the lesson on international standards on auditing on error and fraud. If there's any question, feel free to ask a question and all your questions will be answered. Bye-bye.